We'll begin this course by talking about where tax law comes from. What are the sources of tax law? The Sixth Amendment in 1913 was passed and it provided for taxation. Congress shall have power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. In 1939, less than 6% of the United States was subject to tax, but by 1945, 74% of the population was taxed. And the difference there is war. We had war between 1939 and 1945, and we had to pay for it. Tax laws changed incrementally by Congress, and it's codified into the Internal Revenue Code. We currently use the Internal Revenue Code of 1986. The date is only going to change with major changes to the tax law. So the tax code that was before the 1986 code was the 1954 code, but that doesn't mean that there are no changes that have happened. Change happens every year as Congress meets and drafts new tax legislation, but they're just changed incrementally. We don't change the title of the code. Tax law is made in all three branches of government. Most people think it's just Congress and IRS, but actually tax law is made in all three branches. The legislative branch drafts the code. They draft the tax law. Congress drafts it. Out of that, they have committee reports, and then it's codified into the Internal Revenue Code. The executive branch administers the law. That's their function. In there, they house the IRS. So they develop income tax regulations, revenue rulings, revenue procedures, and letter rulings. And then the judicial branch issues decisions on tax court cases, and that becomes law. As much as Congress and the IRS try, they cannot address every situation that might arise with the code or the regulations or the rulings, etc. And so there are going to be disagreements that make their way to court. And when the court rules on those, they create tax law. They create the way a tax situation will be treated in the future. This breakdown of federal revenues shows you how things have changed over the years. You can see individual income taxes have remained about the same. The breakdown of federal revenues by source is what we're looking at. So of the revenues that the federal government takes in, you can see that income taxes have been between 40 and 45% of that. Individual income taxes have been between 40 and 45% of that through the years. Social insurance taxes have gone up. This is like Social Security and things like that. Corporate income taxes have gone down, and then there's another category which has also gone down. Like we said, IRS administers the tax law. It's a branch of the Treasury Department tasked with administration of the law. They do a lot of things. When you file your return, or when a corporation files its return, the computer automatically checks for math errors and matches forms. So just think about it as an individual. You get a W-2 every year, and your employer also sends a form, and the computer, as those are filed, will scan that in, and they'll match up those two forms. They'll make sure that the income you reported on your tax return matches what your employer reported to have paid you. So these are done by computer. No human does that. And if they find a deviation there, they'll just automatically generate a letter that you'll receive at home. The IRS also conducts audits, and your return would be selected for audit, or a corporate return would be selected for audit. When there are statistical deviations, that's one reason, and not your audit, your tax return or a corporate tax return is assigned what we call a DIF score. And what they're looking for are statistical deviations between another taxpayer, either a person or a corporation, with about the same life circumstances as you. So they make about the same as you, and they have the same number of kids as you, or a corporation that has the same capital structure as you, same income as you. But if your return pays considerably less tax or has a considerably higher deduction amount, that DIF score is going to be higher. And once that return reaches a certain DIF score, it'll be pulled for audit. Another thing the IRS does to select returns for audit is initiatives. Each year, they set out their initiatives for what they're going to look for to enforce. For the last few years, it has been offshore income. They have been looking for income and assets held offshore that the taxpayers are not reporting the income on those assets, on those earnings. And so if they suspect that your return might contain that, or you might have offshore income, they're going to pull that for audit, even if you don't have a high DIF score. Audits can be office or field audits. You can be required to go to the IRS office, or they can come to you. The ones where they come to you are more serious. And then the statute of limitations means how long can the IRS look at my return? Generally, it's 3 years from the date filed or the due date, whichever is later. So if you file it late, that extends the statute of limitations, or 6 years in the case of fraud. Taxation is based on a tax base and a tax rate. The tax base is the dollars we are taxed on. If I earn $100,000 from my job, and I also receive $10,000 from tax-exempt bonds. So tax-exempt bonds means I don't pay tax on that. Well, the tax base is only going to be $100,000, not $110,000, because these are non-taxable interest bonds. If I receive $100,000 from my job and $10,000 in dividends, that's a taxable event, so my tax base is going to be $110,000. Congress can really manipulate how much tax people pay by manipulating the base rather than the rate. People pay more attention to the rate. If your rate goes up, you're angry. If it goes down, you're happy. But they don't pay attention to expanding the base, making more things taxable than they used to be. The tax rate is the other component of that. That's the percentage rate you pay. And in corporate tax, after the Tax Cuts and Jobs Act, the corporate tax rate is a flat 21%. For individuals, the rates are progressive, and that means as the base gets bigger, the rate gets bigger. So if you look in the front cover of your book, you'll see tax tables. Those tables, when you look through them, you can see that as income gets bigger for a taxpayer, the rate goes up. That's a progressive tax type. There's also what we call a regressive tax rate, where as the base gets bigger, the rate actually gets smaller. So this might be Social Security, where you pay Social Security on your income only up to a certain amount and then you don't pay it anymore. That's regressive. Proportional is when the base gets bigger or smaller, it doesn't matter, the rate stays the same. So currently the corporate tax rate is proportional. No matter how much a corporation is making, the rate stays at 21%. There are also marginal, average, and effective tax rates. And again, for corporations, that isn't as important, but it's still going to be important through our course this semester because what we do as a corporation affects our shareholders, and shareholders have these 3 types of rates, so it matters to them. So a marginal tax rate is what you pay on the last dollar of your income. When you look in those tax rate schedules in the front cover of your book, the highest tax rate is the marginal tax rate. The average tax rate is your tax base divided by, it's your total tax that you pay divided by your tax base. So that's going to be lower than your average tax rate because you move through the rates. As your income goes up, you don't always pay that highest tax rate on every dollar. You just pay that highest tax rate on your last dollar of income. So you still get to move through those rates. You still get to take advantage of those lower rates. Your effective tax rate is the total tax you pay divided by all of your economic income. So this is going to be the lowest one of the 3 because there are certain types of income that aren't taxed. Like we talked about, interest on tax-exempt bonds is not taxed. Increases in value of your home are not taxed, things like that. So the marginal tax rate is going to be the highest, average is second, effective is the lowest. We have 4 canons of taxation. This is Adam Smith's theory, and he said a tax system should meet these 4 to be a good tax system. The first is equity, and we have horizontal and vertical equity. Horizontal equity means that we think that, or Adam Smith thinks, and I would presume most taxpayers think this as well. If there's someone who's situated exactly like me, makes the same amount of money, has the same number of kids, same number of medical bills, they should pay about the same amount of tax. That's horizontal equity. Vertical equity says that people who make more than me should pay more tax, and people that make less than me should pay less tax. We feel like that's equitable. Adam Smith also says that a taxing system should be certain. So it should ensure a stable source of government operating revenue, and taxpayers should be able to have some degree of certainty concerning the amount of their annual tax liability. He also says that the tax system should be convenient. It should be easily assessed, collected, and administered, and it should be economical. So there should be minimal compliance and administrative cost. And here I note that the IRS costs are less than 0.5% of the revenues. So the news might lead us to believe that the IRS is losing a lot of money, it really doesn't cost that much to administer the tax code when we're just looking at IRS cost. All right, so often, and then we also have simplicity, which is not part of Adam Smith's theory, but has kind of, through the years, been read into it. So simplicity says taxpayers should be able to understand and comply with any tax system within reasonable boundaries. So often equity is at odds with all the other things. So to make a taxing system equitable, we kind of give up some simplicity, convenience, economy, and certainty. The tax law has three objectives. The first and main are economic objectives. We need to raise money to fund the government. The second is to encourage certain activities and industries. Farming, for example, we believe it's important that we can feed our citizens of our country, and so we give some different taxing incentives to farmers. We do that sometimes with the oil and gas industry, things like that. And then also social objectives. So we want to encourage people to save for retirement, so we give tax breaks for that. This isn't federal taxation, but state taxation charges a higher tax rate on cigarettes. So they're encouraging people not to smoke. These are social objectives. All right, so who pays the taxes? Well, we all pay taxes, but the direct tax-paying entities are only C corporations and individuals for federal income tax. The other entities below flow through, which means that while they earn money, and most of them, have to file a tax return, they aren't actually legally liable for paying the tax. Only C corps and individuals are. So these flow through entities we'll talk about more in another chapter, but sole proprietorships, partnerships, S corps, LLCs, and LLPs. I have trust down here as most of the time, because trust can sometimes, if they hold too much money in trust, they can owe some tax. And just briefly, when people think of tax careers, they usually just think of tax compliance, preparing tax returns. But that's not really the only thing you can do. You can engage in tax research. You can engage in tax planning and consulting. And you can engage in financial planning. And in all of these careers, tax is a very important component of this career. The Tax Cuts and Jobs Act of 2017 was the largest tax reform in 30 years. And it, of course, created winners and losers. The IRS is behind on the guidance still, even though the filing season has begun. The aim was simplification of the tax code, but it introduced a lot of new complicated provisions, so I'm not sure it really simplified things. It just kind of changed some things around. The most important thing for our course is that it reduced the C corporate rate the tax rate to a flat 21%, where it used to have multiple rates. Now it's a flat 21%. This is great for large corporations. Their tax rate has been cut dramatically, but not everyone wins, because under prior law, C corporations with $50,000 or less in annual taxable income were taxed at a 15% rate. And this included most C corporations make $50,000 or less. So this hurt a lot of small business C corporations. So some interesting quotes about this that I found. And on March 6, 2018, the Secretary of the Treasury testified that implementing the new law will require a great deal of work. The IRS will need $397 million in order to carry out this critical mandate. But on March 23, 2018, the president signed the act, which only provided $320 million for implementation. So we're already underfunded here to get this thing implemented. The IRS doesn't have enough resources or people to get it done. Completing the guidance on the new act will take the IRS years. And again, this was signed into law in 2017. So right now, during this filing period, we are supposed to be relying on this guidance, and a lot of this guidance doesn't exist. It includes reprogramming approximately 140 interrelated return processing systems in conjunction with creating or revising approximately 450 tax forms, publications, and instructions, publishing guidance, notices, and frequently asked questions, preparing the IRS workforces to help taxpayers understand how the new law applies to them, and importantly, providing the taxpayer assistance and outreach. So this is what the acting IRS commissioner said. As you can see, this is a huge change in tax law, and it is really going to have a dramatic effect on this filing season. It will be interesting to see what happens. According to the Tax Policy Center, which is a bipartisan nonprofit tax research center, the new tax law takes millions of people off the federal income tax roll. So in 2018, 4.2 million people will no longer pay federal income taxes. Under the current law, which when they say current law, they mean pre-Tax Cuts and Jobs Act. Under current law, 43.4% of households will pay no federal income taxes and get net refunds in 2018. But once Trump signs, and he has, so now that Trump has signed the Tax Cuts and Jobs Act into law, that share climbs to 45.8% of people who pay no federal income tax.